Welcome to the Snowbirds Expat Radio Podcast, powered by the Snowbird U.S Day Tracker app. I'm your host, Gerry Scott, and my goal is to give you answers to your cross-border questions, to ease the stress of a cross-border move or extended trip, and to keep you up to date on all you need to know with cross-border rules and regulations. Now let's get on with the show. Well, welcome to the part 2 of inheriting assets on the other side of the border. We have Aaron Dawes back with us from Smythe. You're listening to this Snowbird Expat Radio Podcast. Aaron, welcome back. You've become a co-host this last couple of weeks here.
Yeah, thanks for having me back.
Well, let's jump right into it because today we're going to kind of address these as when I went online to prepare the questions. These are concerns that American kids should have. I call them children, when their parents pass away and they're going to inherit these parents' assets. So we'll address these all as concerns, and then Aaron, with your expertise and knowledge and being the big kahuna of Vancouver, we use that word a lot, big kahuna in Maui here. We'll jump right into it. So once again, today it's going to be Canadian children inheriting assets from their American parents. So let's start off with the first concern we have is, what are the type of assets that are being inherited?
So there's some different things that we typically see in our practice. So number one, cash. Cash is cash. We're not too concerned with inheriting cash from U.S. parents. Real estate is another big one. And, the main question we would ask when it's inheriting real estate or investments is, how did the U.S. parents hold those assets? Meaning, did the U.S. parents hold the real estate and investments directly as individuals, or did they hold them via a trust? And the reason why that's important is if it's held via a trust, the reporting from a Canadian U.S. perspective might be a little bit different. So that's something we commonly ask. And the reason why it sometimes gets missed is it's very common in certain states for U.S. people to set up what we call living revocable trusts. And the whole objective behind these trusts is usually to avoid probate. What can happen from a Canadian perspective is, if these investments in real estate were held directly, then the Canadian beneficiary would receive what we call the basis based on the date of death value. Whereas if the assets are held in the trust, it's the original cost. So it's going to be the price at the time the trust purchased the investments, or a value when the assets were transferred into the trust. So we really look through how the investments are held and how the asset is held.
Now, it's quite common when these people set up these irrevocable trusts in the United States, they're cheap to set up and they roll everything into the trust. And then, of course, that's a different thing. It's a different bird up here in Canada. Mm-hmm. Maybe explain the two differences between the two trusts.
So for U.S. purposes, it's a flow through, meaning you could put your brokerage accounts into the revocable trust. The income flows through and is still taxed on the individual's personal tax return. Whereas from a Canadian perspective, Canada would see that revocable trust as a separate entity. It's not a flow through, and it's taxed for trust purposes, or as a trust versus as an individual.
Okay, but we're seeing it all the time now. And then we also see that issue when all of a sudden one of the trustees moves up to Canada and it becomes a Canadian trust.
We do it, and now it's just a default question we ask. Like, these revocable trusts are so common for people who live in certain states. The one that comes to mind a lot is California. So when we have a new client or individual we're speaking to that's moving to Canada from California, that's one of the first questions is, do you have a revocable trust? And it's the reason why we have to ask that question is it's something that's often just doesn't get disclosed, because from a U.S. perspective, it's no different. Like, it's still taxed as an individual, and they often don't know that Canada is going to have some separate treatment for that trust.
So what are the U.S. estate tax implications? I know we talk about this federal estate tax exemption of 12.92 as of 2023. How does that come into play from a tax perspective?
Yeah, so it's an indexed amount. So it's actually for 2025, it's just shy of 14 million USD. So it's 13.99 million. And what the U.S. estate tax is, essentially, it's a death tax for high net worth individuals. So the way I explain it to my clients is, in Canada we have a different system. When somebody passes away, we have what we call a deemed disposition of their assets on their death, and that's based on the capital gains or the unrealized gains on the asset. From a U.S. perspective, they have an estate tax, and it's based on the market value of the asset as of the day of passing. So if a U.S. person were to have, say, an estate worth, say, 16 million USD, there would be an estate tax element here from a federal perspective because it's above the exemption. And then depending on which state they live in, there could also be a state estate tax. There's about I think it's 12 or 13 different states that have their own estate tax system.
Now, what are the tax obligations for on the Canadian side of this Canadian beneficiary receiving assets from the American parents?
Yeah, so if there's Canadian assets, so the one that comes to mind here is U.S. parents perhaps hold some Canadian real estate. Let's say they have a vacation property, maybe Vancouver Island. So that vacation property falls into the U.S. estate tax system, but also because it's a Canadian asset, it would be subject to Canadian deemed disposition, just taxation on death based on the unrealized gains. And there's a bit of integration between the two systems. And what that means is, because the deceased person is going to be paying some Canadian personal tax, there's a credit that's available from a U.S. estate tax perspective, just to ensure there's not any double taxation.
Okay. Now, we also talked about, are there any cross-border tax treaties that will allow you to transfer these credits back and forth?
There are. So it depends on the countries. Canada and the U.S. have a tax treaty, and it comes into play both from an income tax perspective and an estate tax perspective. So this could apply for the estate. So the example I just mentioned, where Canadian real estate, and that's subject to personal tax in Canada as well as estate tax in the U.S. It can also apply to the beneficiaries inheriting the assets. So let's just say that the U.S. parents have a U.S. brokerage account. It's paying out some U.S. dividends. Canadian beneficiaries inherit those investments. There's tax on those U.S. dividends. Under the tax treaty, Canada would give you a credit for any taxes paid to the U.S. So you get out of the double tax system.
Now, what we find, which is very, very interesting, is that if mom and dad pass away in Canada and you have Canadian beneficiaries, they have these registered accounts. The estate's responsible for the tax, and then it goes into the final tax return for the parents, which could be a lot. But in the United States, they have what they call these beneficiaries, if they live up in Canada here, can inherit an inherited IRA. Tell us some of the advantages of the inherited IRA. And I love this. This to me is just, I wish somebody in Ottawa would wake up and allow us to do something with our parents. Large rifts.
Yeah, really the benefit of the inherited IRA is just taking the value of the U.S. pension account over a number of years. So often you can receive the inherited IRA over 10 years. So to give you an example, let's say that a U.S. parent passes away, they have an IRA valued at $500,000. By rolling it into an inherited IRA, you could pull out, let's say, $50,000 per year over a 10-year span and pay tax at the lower progressive rates versus having to take, all $500,000 at once. For a Canadian tax resident in most provinces, you're being in the top rate, paying upwards, if not more than 50%. So pretty significant tax savings by taking an inherited IRA over a number of years versus a lump sum.
We also find that if mom and dad are passing away or at 80 years of age, the children are in their 50s and they're already earning that high income. So at least with the inherited IRA, they can do a lot more planning around that to say maybe it's 50 grand a year, like rather than the $500,000. So that's a great point. So how do those how will a lot of these assets be transferred from an American now transferring that money to Canada? How do those transfers take place, those assets?
In terms of the IRA or just all assets
No,
in
let's
general?
talk. IRAs are pretty straightforward and simple, but let's talk about real estate. Mom and dad have this incredible shack down on the beach in California. Rather than selling it, can those kids actually inherit that property? And what does that foreign ownership mean to them? And
They can. So in this example, there wouldn't be any income tax on the parents passing on this U.S. property. There could be an estate tax that we've already mentioned. So through the wills, the property would pass through those Canadian resident children beneficiaries. If these were vacation properties, then there's not going to be any additional reporting until possibly down the road when these Canadians sell the U.S. real estate. Whereas if maybe these are income producing properties, they're part-time vacation rentals, earning rental revenue, then the Canadians would have to register for a U.S. tax number, start filing U.S. federal, possibly state tax returns to report that rental income and the expenses.
so the number that they would receive would be a TIN number, a TIN number rather than a social security number.
Correct. Yeah, you can only obtain a social security number for a non-U.S. person if you're on a work permit. So they would apply for an ITIN, yeah, a tax number.
So we inherit mom and dad's beautiful shack down in Marino Del Rey. Just saw a great video on it today, actually. Got me pretty excited because I grew up in the water and I loved boats and water, the whole works. But how should those kids, what planning should they do when they come to you and they say, Mom and Dad had this beautiful shack. How should we own it? What structure would you recommend to them to inherit that
I would say
asset?
I would say it all depends on if this is vacation property or if it's income producing. There's generally not a lot of planning after the fact. So in terms of structuring, you usually want to set up before the property is received or before the property is purchased. So, but there's different options in terms of holding the property into a partnership. That's an option. You could hold the property in a Canadian corporation if there's going to be rental income. One of the questions I would have is, what's the objective? Is this going to be a long-term legacy property passed down from generation to generation? Is the objective to avoid potential U.S. estate tax in the future? So I would say, to answer your question, it really depends on the fact pattern and what the objective is of the children, but just knowing there are some different structures based on what they're looking to get out of the property.
And how much planning do you find? Because let's say, for example, Mom and Dad live down in California on the water. They've got their own U.S. accountant. Mom and Dad probably haven't mentioned the fact that, or even if they did mention that they have their kids, their beneficiaries live in Canada, that accountant is going to be very restricted on what he can do. So who initiates that conversation? Because mom and dad it's such a sensitive issue for the kids to say, they come to Aaron and say, Mom and Dad got this beautiful shack. How should we structure it? What is the process along the way that you're finding in your business?
That's a good question. I'd say a lot of it depends on the family dynamic. So I see some families, there's kind of a cohesive discussion. So it's myself, potentially a cross-border lawyer, a state lawyer on a call with, in this case, Canadian children with the U.S. parents. I've had some situations where the parents do not want to discuss, the estate with the children, and there's not really any opportunity for planning. It's all kind of post-mortem. So I would say it really depends on the family dynamic, and also that the parents, if they're willing to share. Sometimes the parents are more secretive and aren't willing to share with the children, what potential assets they could be inheriting.
Now, here's the other dynamics on this is if these are American, mom and dad are living down in the States, the probability is the kids who are now live up here in Canada are dual citizens. I mean, does that complicate things that much more when you're having to file 2 tax returns now?
It can be. It can. So there's definitely 2 different filing obligations, one in each country. Part of this is how are these assets held, because the 2 countries have very different rules. And going back to our earlier discussion on the trust, could be considered a flow-through vehicle in one country, the U.S., and a separate entity in the other country in Canada. So certainly by being a U.S. citizen living in Canada, it adds a additional level of complexity. And that's why I think it's so important to speak to a cross-border advisor. I think individuals who are working with domestic accountants are essentially doing themselves a disservice by getting U.S. centric advice from a U.S. practitioner, Canadian advice from a Canadian practitioner, and nobody's looking at the whole picture. And that's where I find things are just being missed.
So as we have this conversation, I'm thinking that mom and dad have two kids that are still residing in the United States, but then they got this one child who's moved up to Canada. So when it comes to dispersing the assets, does it make more sense to disperse the cash to the child living in Canada and make it easier, and then the other two children might get the hard assets?
That's what often happens if the assets are held in a trust. And the reason being is the U.S. Resident beneficiaries would receive those assets that they inherited at that date of death value. Whereas if they're in a trust, the Canadian resident beneficiary wouldn't receive it at the date of death value. So often what we'll see is, the children want the underlying investments. So the investments get transferred to the U.S. resident beneficiaries. Maybe they sell the family home, the cash gets transferred to the Canadian resident beneficiary. So to answer your question, it is quite common. And that's why we have to look at, again, how are these assets held? It's because the rules can be very different across the two countries.
So that individual who now receives, let's say we're going to throw out some big numbers for you. They receive $1 million in cash. They're in Canada. How is that $1 million in cash taxed, especially if that Canadian who lives in Canada is still obligated to file 2 tax returns?
That's a very common question, and it's not taxed. So if it's just cash is cash, there's no tax. What I'd tell people is if you inherit assets and those assets are producing income, so think rental revenue from a real estate property, or think investments, capital gains, and dividends. If those assets are, if those assets are producing income, now there's tax implication. But just receiving cash, there's no tax implications.
So we're assuming everything goes well. What are some of the problems when things don't go well? You get called in and you have to clean up these estates. What are the most common problems you're seeing on a cleaning up of an estate?
I would say just late filings and disclosures. So what we often find from a cross-border perspective is the disclosure forms for disclosing foreign assets on both sides of the border, but maybe more so from a U.S. perspective. That's where these hefty penalties are. So sometimes we find is we get involved after the fact. It's not necessarily an income tax concern. It's, hey, there's some forms that should have been filed and there is a penalty exposure. And maybe that penalty exposure is 25% on, inheriting a U.S. person inheriting assets from a foreign estate. So these amounts can grow pretty large. In your early example, if we have someone who's inheriting $1 million, who's a U.S. person from a foreign estate, and they don't file a certain disclosure form, well, that penalty can be as high as 25%. They could have a $250,000 penalty. So that's what we usually get involved with is voluntary disclosures and finding ways to file these disclosures that have been missed, unfortunately.
So what is the best way from an estate planning point of view? What are you suggesting to your clients when you've got the whole situation? You know where all the children live up here in Canada. Some live down in the United States. What's the first step to try and get these people to do the planning, not the estate distribution, but really good planning? What's the first thing that you can tell these families?
Yeah, the first step is getting the right people involved. So you want a cross-border tax practitioner like myself. You want a cross-border trust estate lawyer. You probably want to ensure that there's wills on both sides of the border, depending on the asset holdings. So is this making sure that the professionals looking at it, whether it's an accountant or a lawyer or a financial planner, are looking at it from a broad cross-border perspective and not at each country in isolation?
We can't stress enough that this is, as we hear about this, the distribution of the wealth from one generation to the next generation, it could be the greatest transfer of all times. We have to stress that, and families really have moved to both sides of the border. I mean, we're seeing a lot of it, you're seeing a lot of it. So the point that Aaron really stresses, making sure you get the proper professionals involved, because the U.S. accountant, as kind and charming as they are, intelligent as they are, do not understand cross-border issues. So that's why the importance of this podcast is introducing Aaron to the people that follow this podcast and people that have downloaded the Snowbird US Day Tracker app and the Canada Physical Presence Tracker app. So, Aaron, once again, we thank you. I know you're a busy guy, but thank you very much for your time, and we'll make sure that there's other topics we'll cover with yourself as well, because we appreciate your intelligence.
Thanks for having me. I really appreciate it.
Thank you again for listening to the Snowbird Expat Radio Podcast. The best way you can support the podcast is to forward the episode to a friend, and please don't hesitate to like, subscribe, or leave a comment. Now, before you go, let me leave you with one of my favorite quotes. Be kind to all, the world is small.